money is not safe in the current world we live in if you're like the average American. This pains me to say it, to be honest, but the world has changed. Think about it. We've experienced the largest rate hikes in history after the biggest government forced business closures in history, etc., etc., etc. We are in uncharted territory, to say the absolute least, but here's what we know for 100% certain. The stress of all these circumstances, especially the Federal Reserve's steep rate hikes that we've seen, are causing massive stress on all banks from top to the very bottom. And now we're seeing bank after bank failing, with Silicon Valley being the most well-known in recent months. So at this stage, a lot of people have had some big questions about banks and other financial institutions. After all, aren't all banks the same? Not really at all, actually. In fact, many are not even actual banks. You may conduct your banking tasks with a bank, a credit union, a broker, or even an online financial institution, which the majority of those are not technically banks. Which one you choose might affect how much you pay in fees, how much you receive in interest, and how safe your money really is. Let's jump in to learn more. So what is the difference between different types of financial institutions? The type of financial institution that most of us think of when we hear the word bank is a major commercial bank, like the Wells Fargos, the Chases, and the Bank of Americas of the world. These national companies dominate the market by pure market share. That is specifically true for consumer and corporate accounts. Credit unions are smaller to banks, but their members own them technically and don't see profits like corporate organizations. And then finally, we have thrifts, which fell from favor in kind of the late 80s. They're typically known as savings banks, etc. Let's start with savings and loan associations. Savings and loan associations, aka S&Ls, aka thrifts, or savings associations, these groups typically focus on loans, and they're typically for real estate. Additionally, it's very common for them to have depository account options as well. Some of these might be publicly traded, and others are owned by their actual customers. In the event they are owned by their customers, they're often called mutual associations. So as mentioned, the S&L industry suffered a sharp decline after the crisis. The problem was that while these institutions had most of their deposits tied up in long-term mortgages, rising interest rates forced them to increase the payments to depositors. Between loose regulation and unchecked growth, S&Ls were not adequately supervised, and that ended up with a crisis. Ultimately, the federal government bailed out thousands of these saving institutions to keep them afloat. And in 1989, Congress passed legislation that reformed the oversight requirements and moved the regulation and insurance to the FDIC. Next, we have credit unions. Credit unions are actually technically non-profit institutions that are also owned by their members. Their regulation and insurance is regulated in a group called the National Credit Unions Association. So in the early 1900s, credit unions started as groups of people sharing a common bond to work together in a banking manner, mainly by offering their members savings accounts and small loans for personal or business use. Today, the common bonds between depositors are much looser, and the credit unions are often much larger, so in a lot of ways they operate pretty close to a traditional bank. In the past, credit unions have had a reputation for being willing to take a chance by approving a loan for their members when a larger bank might have declined that application altogether. However, as credit unions have come to more closely resemble banks, those differences have largely faded, and commercial banks and credit unions have operated pretty closely on their rates and terms. And last, we have commercial banks. So commercial banks are generally full-service operations. Often they're publicly owned, and they are very clear that they are seeking profits and returns for their shareholders. Most commonly, these are large and federally chartered institutions, but there are some medium-sized and regional banks that have state-chartered in that mix as well. The vast majority operate under the Federal Reserve System, which enables them to access lower rates for loans and currency exchange for their institution. The FDIC, aka the Federal Deposit, insures all commercial bank deposits up to a maximum of $250,000 per account. Sometimes though, that isn't enough, especially for the high income or the high net worth individuals. Could you imagine for people with multi-millions or even billions of dollars having those levels of deposit amounts only insured up to 250 grand? That is a huge risk for these individuals and one that they need to monitor pretty regularly. For example, when Silicon Valley Bank failed after a run on their deposits, the FDIC stepped in to reassure customers that all deposits, even those above the maximum, would be paid out to the depositors. This FDIC action was designed to avoid a domino effect on other banks, especially the smaller banks, and more or less this succeeded. But the impact was still there because the Silicon Valley Bank failure was the largest that we've seen in the US since the 2008 financial crisis. And it was actually the second largest failure in banking history in the US. And it's significant to note that one individual can have accounts at more than one financial institution and still receive the maximum protection for each account. So with all that said, with all the regulations, with all the oversight, why exactly are banks still failing? What set the stage for this banking failure is a combination of factors. First, bank runs can now take place instantly and without anyone showing up at the actual bank to claim their physical money. In the past, and for instance, the Depression era bank failures, depositors had to physically show up by waiting until the bank opened and then stand in line to demand their deposits that day. Today, however, account holders can simply press a few buttons on a computer or phone even to transfer assets from one bank to another. Second, banks have different capital requirements depending on their size. The largest institutions must demonstrate greater resilience than banks with fewer assets, like Silicon Valley Bank. SVB invested heavily in bonds immediately before bond prices began to rise, which reduced the relative benefit of those prior bond purchases. So when SVB suddenly needed liquidity, aka cash, to pay depositors who needed access to their deposits, the bank had to sell some investments at a pretty significant loss overall. And that news of that massive loss caused investors to worry about the bank's health as a whole, and the sequence of events caused a cycle that the bank could recover from. For most consumers, $250,000 is plenty of insurance, but the FDIC determined that in this case, with so many of SVB's customers holding much larger accounts, it would be catastrophic for those consumers to lose their money in that instance. The primary concern was a series of additional failures, as other banks, such as First Republic, Signature Bank, and some others, were also showing signs of distress. So what's the bottom line then? For most consumers, there's actually little risk that they will lose money in a bank failure. That's kind of the reality. Over the last 20 years, banking reforms have significantly reduced the exposure to the overall system, and the current supervision is generally pretty tight and effective, especially since 2008. Still, if you have significant assets in one single place, it's probably time to start considering spreading those deposits around just to cover your bets. And if you've been following us for a while, you know that savings accounts rarely keep up with inflation. So please do yourself a favor and find investment and money options that will cover inflation for your portfolio and maybe even make you a few bucks too. Trust me, you are worth it. Also, I have some really good news for you as well. To help you in this crazy market, I can send you a copy of my personal notes that I just took recently at an investor mastermind that I paid over $58,000 to attend. There's over $500 million of real estate value in that room from investors, and people traveled from all over the world to be there. If you want a copy of my $58,000 notes, comment the word note below in the comments section, and we'll send you a free copy of the notes that cost me tens of thousands of dollars. Also in this environment, you absolutely must understand the inflation picture that we're all living in and going to be living in for a while. I'm putting up a link to an extremely valuable presentation that we put together on inflation, where we put the inflation picture into the best explanation that I have seen so far. Check it out and protect yourself and your investments. Of inflation ahead, how to navigate this, how to manage your portfolio and invest through this. And something really interesting happened.